Westpac is flagging the possibility of lower borrowing costs for customers as it refinances high-cost funds borrowed during the height of the global financial crisis. The lure of Jam Tomorrow from Westpac's boss, Gail Kelly, was part of the bank's response to its high-profile battle with NAB for mortgage customers. Here's Andrew Robertson.
Competition of a very visible kind appears to be returning to the banking industry to the point where at least some bank investors are starting to worry.
Healthy competition is fantastic and it should be there for all banks to address, but too much competition, excessive, can be destabilising for our economy.
Westpac has hit back at National Australia Bank's abolition of mortgage exit fees with a package of cost reductions across a range of products aimed at keeping the customers it's been winning in the battle for homebuyer business.
This is not a single product play, it's about a package approach, depth of customer relationships. So that's our way of competing.
Mrs. Kelly was speaking as she unveiled Westpac's first quarter trading update. Cash earnings were up 5% to just over $1.5 billion. Despite higher borrowing costs, net interest margin was also up and impairment charges continue to fall as the impact of the global financial crisis washes through. It wasn't all good news, though. Lending at St George Bank was less than expected and the Queensland floods took at least $50 million off pre-tax earnings.
It's a tad more than perhaps I would have expected given their size in the insurance market, but in the scheme of things, it's just a little bit of noise. Overall, the bank's quite well positioned.
With the big four banks under pressure in recent times over increases in their borrowing charges, Gail Kelly has foreshadowed actually cutting lending rates in the next 2 to 3 years.
We've got the 5-year money that we put in 2014, to 2009, and that rolls off, and that was very expensive money at the time. So really looking forward to that time. And, then you'll see quite a significant reduction, actually, in costs, and it'll be great to be able to pass some of that benefit on to customers.
However, Constellation Capital's Peter Van says there's a lot of water to flow under the bridge before that actually happens.
Now, I assume that will follow through and we'll wait with bated breath to see if it happens, but by that time there'll be many other moving parts too, so all that may be just buried in the noise, but we'll see.
While Westpac has flagged the possibility of lower borrowing costs for its customers in the medium to long term, in the short term they may be going up. The minutes of this month's meeting of the board of the Reserve Bank indicate the RBA is ready to raise interest rates again if it feels it's necessary.
Despite, I think, the floods in Queensland, despite some developments globally, at the end of the day, their story is very much the same, that the terms of trade are historically high, underpinned by a very strong China and Asia.
Which Su Lin-ong believes will lead to 2 interest rate rises this year. And the Reserve Bank has advised China's central bank to also keep raising interest rates. Inflation in China is running at just under 5%. At the factory gate, it's nearly 7%, with food inflation at more than 10%. According to the Reserve Bank, monetary conditions appeared to remain accommodative for such a rapidly growing economy, something Su Lin-ong agrees has to change.
At the end of the day, we think that's what's needed to ensure long-run sustainable growth in China, and of course that'll be fairly important for Australia, and ultimately that's what you want to see. You don't want to see an overheated economy at risk of bust.
China's central bank has raised interest rates 3 times in the last 4 months as the inflation rate has doubled.